Let's begin now speaking about different positions we can take to profit. When we developed the four pillars and decided to name them, I was almost tempted, in fact, I was tempted to call this one positioning. I just like cash flow. So, what this entails, remember, is just to review what we're doing here, is we're looking to get information on this side. Information on this side. And there's really nothing we can do about this. I mean, the fundamentals will be what they are, and the price chart will be what it is, and we don't have any control over here. Over here is action. This is where we have, absolute control. We decide how we want to position ourselves. So in the introduction, we talked about all kinds of different positions. Do you want to, there's many attributes that a position can have. First is the asset. Do you want to position yourself in real estate, or do you want to position yourself in stocks, or position yourself in business or cash? Second is whether we're going to own something, or what's called a long position. We want to buy it, or maybe we want to short it and have some promises involved. Maybe we want to use some leverage, as we saw earlier. Debt as a lever, margin as a lever. Do we want to have a levered position, and on and on and on? Do we want to have a hedged position? So there's so many different positions that you can take. And so let's start off a little bit as we get into what is called a long position. And that's generally what people think of when they think of investing. Where am I going to try to grow my wealth? So we start off maybe with currency. Maybe we borrowed some money and now we have some money or some currency to invest somewhere. Or maybe we've socked some away, but in some way we have some currency. So I live in the U.S., so my home currency is the U.S. dollar. And I can certainly make that a position. I can certainly say, you know what, I want a cash position. I don't like any real estate right now. I don't like any stocks right now. I think I'm going to go to cash. I think things are tumultuous, and maybe I just want to have a cash position. I know that often Warren Buffett really likes to have a cash position so he can seize opportunities, have a little bit in cash. Me, myself, I only like enough cash for my needs. I feel like other stocks are liquid and I can go to cash quickly if I want to, and I don't like the idea of the dollar losing value and therefore having my my net worth be weaker because the cash loses value. And so that's a cash position. Now maybe someone would rather be in euros, so this is still a currency position, right? It's still currency. And when you think of currency, you might even think of a river, right, that's flowing, right? A river that's flowing. Because usually currency is designed not really as an investment, but it's really designed to be a medium of exchange, which leads us to Bitcoin and other cryptocurrencies. I think that many people are treating cryptocurrency much more like an asset rather than a currency. Rather than just simply, I think I'd like to be able to spend money and get goods and services. So generally currency is about a medium of exchange. It's something I can use to get goods and services. So my personal preference, for me, it might be different for you, is to have enough currency in my account to run my life, to buy my groceries, pay my doctor bills, pay my cell phone bill, whatever it might be, take the kids to Disneyland, whatever it might be. That's really the purpose of currency. But some people do treat it as an investment. The foreign exchange, where you get a pairing like this of maybe U.S. dollars and, say, euros, for example, we call this the foreign exchange market, is the largest market in the world. These change hands a lot. A lot of it is because people are going to be buying goods and services and want a different currency to buy those goods and services in, but other of it is speculative, where people think, gee, I think the dollar might get stronger and the euro might get weaker. I think I'll go with that pairing and see if I can profit. So we have a cash position. So we have, other aspirations to do classes on Forex trading if that's your thing. The four pillars work for this: fundamentals, technicals, work for this type of thing, cash flow and risk management, and also for Bitcoin if you want to do that type of a thing. It will work. The four pillars will work in any of them. My personal opinion is, again, as I stated, I like these positions for buying goods and services. And so Bitcoin, you'll notice, is often treated as real estate or a stock, as the value. They're more worried about the value of Bit going up and down than they are saying, hey, I think I could get some Bitcoin so I can, buy some online stuff. People are more worried about the euro going up or going down rather than, oh, I'm going to Europe. Maybe I ought to get some euros so I can, go have a coffee in Paris or whatever. And so that's an interesting mentality is, do you want a currency position? And I do dabble in a little Forex now and again. I'll certainly confess that when I see an opportunity there, I like that. George Soros lives here, man. He loves this stuff. And so that's that. Now, traditionally, though, this is what people think about when they think about investing is, should I put my cash in real estate? Should I put my cash into gold and silver? Should I put my cash and start a business? Or should I buy, stocks and options and things like that? And we have four basic asset classes that I've served as a Rich Dad advisor for many, many years, and this is the way we've taught this always is when you have an asset column right here, right, and a liability column, the question is, what do you put in there? And generally there's four things you can put in there. Now, currency might be called a paper asset, but you have business, real estate, paper, and commodities. I use the term paper asset because that's the way we've taught it for so long. I don't prefer it personally. Because what it does is it makes people, one of the biggest erroneous ideas that I've seen floating around out there is that someone will say, well, these aren't real because they're paper. And that is just the silliest idea. I just reiterate over and over again because I've been to so many conferences that say, well, this stuff is real and you can hold it in your hand, and this stuff is just a piece of paper, and so I'd rather have something real. I can walk up and, knock on the door here, but here, what can I do? Well, the reality of it is, yeah, you could go and knock on the door here. Well, you can go to Disneyland and knock on the door there, or to their corporate headquarters. Or you can go buy their movies, which are very tangible and real. You can have a Blu-ray disc that's their products. It's very real. Go have a Coke and a smile. Go, get some A&D ointment from Johnson & Johnson or Pfizer, whoever makes that. And so these are very, very real. As a matter of fact, I tell this story 2 or 3 times in this course, and I say it to reiterate. I was sitting with a good friend of mine who's a gold dealer, and of course, being a gold dealer, the confabulation is everywhere. It says, well, this is real, and don't buy stocks because these are real and these aren't real. And I said, well, if I wanted to buy $1 million in gold from you right now, that seems like a lot of asset to have in my house. I mean, I know that the bank has a vault and a security guard and a full-time surveillance system just because they might have $1 million in their vault. He says, oh, no, never store that much gold at your house. I go, well, if I buy $1 million of gold from you, where should I store it? He goes, well, I'll store it in my vault. I'll store it in my vault. I go, well, how do I know the gold's mine? He says, oh, I'll give you a receipt that says it's yours. I go, what's that receipt made of? And he just smiled a million years, a million mile wide, because he knew that really there's all kinds of different money. I can have a gold round, and that's certainly money. And I can also do what he said, which was the beginning of what we call receipt money. When for that very reason, people didn't want to haul around. It's heavy. It's easily robbed. You watch A Million Ways to Die in the West, and that's how the movie starts. This prospector gets robbed of his gold. So keeping it safe and secure, now we have a receipt, and that's really what a deed is, isn't it? or I might incorporate. And if someone says, "Do you have a business?" I go, "Yeah." They go, "Show me your articles of incorporation that you filed." So we have this idea of going from a primal species to a social species. Oh, believe me, we're still primal. But it really comes down to what we believe in the power of a government. A government will say, well, is this your real estate? Well, we're still going to tax you on it. This I'd get taxed if I made money on it. Here I get just taxed by owning it. I own it, I get taxed. There's been times where the government has said, well, it's illegal to own this. You're not allowed to own this. There's government different rules for different taxation here. So really it's about, what the governments of the world say or what pieces of paper they honor. So just because we have representations of a paper asset here, don't for 1 minute think that the richest guy in the world, which is Warren Buffett, that his money isn't real, that his, however many $1 billion he's worth, that's not real asset, that's all fake stuff. Absolutely untrue. Now, there are fake teachers and fake assets, and there certainly is, but I would not for a minute say that these things are not real. That isn't to say we don't need to have a discussion on 401ks to show in what ways they're not a real asset in the terms of who's getting paid. If you have a mutual fund and you're paying fees and that's taking out of your pocket, well, yeah, those are real stocks in that mutual fund, but it might not be an asset to you because you might not be getting paid as well. So, they can become a fake asset in terms of whether they pay you or not. But as to whether or not this Walt Disney Company is real, Mickey Mouse is everywhere. So with that, the idea is how do I position myself and how do I decide where to move my money around? And in doing that, we really allow our financial statement to begin to guide us about what we want to have. Now, again, this is not an advanced class. This is a beginning class. This is a primer for investing. But I mentioned those 8 numbers that would change your life. And, every single one of these 8 is affected by what goes in here in number 4. Every single one of them will be affected by what happens here. So let's talk about 3 goals that you might have that can let your financial statement guide you about which ones or which one or which kind or type of these investments you might decide. Do you want to have a cash position only? Do you want to put all your money in stock? Are you a real estate only guy? Or are you like me where you like to have all 5 of these, all 4 asset classes and a little bit of cash there? So let's look at this idea from a standpoint of positioning, and let's see how the financial statement might guide us. In my opinion, the most important result that a person can get as they invest would be to increase cash flow. In my opinion, that to me is my favorite. If that, to me, that represents a ton of freedom. Now, of course, if this gets massive, you can enjoy the same types of freedom because you won't outlive if this is 5 billion, you're not going to outlive that. You're going to be just fine, right? So there's nothing wrong with having a net worth that is large. If you have $5 billion, you're going to be okay. And even if your cash flow pattern looks like that, the amount you'll spend in a lifetime, and it's just not going to be a problem. But for most people that want freedom, okay, if that is something you care very much about, not just buying stuff, but buying freedom. Let's think about becoming wealthy in 2 different ideas. In fact, you could think of it this way, and my friend Than Merrill will often say this, and I like this idea, is people have active income, they have passive income, and then I threw my 2 cents in and said, well, this might be legacy income. So active income is when we work for money. And you can work for money and buy cars and get out of debt and all that type of stuff. But passive income is when money works for you. And when a passive income, gets above the expenses, a person is free. And this is the one that this is the first step in status that people really care about. So think about this. Do you want to be rich so you can buy stuff? Because if that's the case, then you can get a higher paying job. You know, you can go to college and you can go from being a worker bee type employee to maybe a heart surgeon, and you can have a Mercedes, and you can have $1 million home, and you can have a membership at the country club and so forth. However, you will have to go do surgery as long as you want that money to come. So if you just want stuff, jobs can do that. But if you want freedom, which I think as you study happiness and the neuroscience that we now have, freedom is really makes people more happy, having choices and having the ability to choose things and not being forced and having their freedom removed. That seems to bring the most happiness, is the freedom of it. And so to become wealthy, for the idea, I mean, you can buy the cars and the stuff you want, but to release yourself from having to do things you maybe don't want to do if you don't feel like it, and having freedom, that's a nice deal. And then the other problem or challenge, I don't know if it's a problem, but let's say I go get an MD degree, or I go get a law degree or whatever, or even a bachelor's degree, right? I don't get to bequeath that to my kids. So if I want a legacy, right? If I want legacy income, I don't know how to spell legacy, probably like that. If I want legacy income, I don't get to say, well, I'm dead now, I'm going to give you my, my daughter gets my MD degree, and my son gets my bachelor's, and my other daughter gets my master's, and you don't get to bequeath that stuff. But your assets, such as your business, you could give to them, your real estate you can give them, your stock you could give to them, and your commodities, your gold and silver, you could give to them. And if this builds huge, and you can even go outside your family. Most good people, once they experience freedom for themselves, tend to want to use that time and resource to bless other lives. I think that's been the case with Bill Gates and Warren Buffett and many, many wealthy people, where they start foundations. Eccles is like that. John Huntsman was like that, where they begin to get legacy. So that's really an interesting idea. Where do you want to go with it? So a cash flow going up from passive income like this is really, really exciting. And so that's why we call ourselves the Cash Flow Academy. But not because that's the only one we teach or the only one you could do. It just seems to be our favorite, and a favorite of our students is to work towards a cash flow that exceeds expenses. Now, another strategy is you can do for capital gains, and we will teach that as well. It's less of a favorite of ours, but there are times where there's an opportunity where you might, for example, the devaluation of the dollar is affecting your net worth, right? That's a big deal. And so we learn about this. And then also there are times where we want to protect, and where we might go into a time of turmoil where we might say, I want one asset to offset the other, and this is called hedging. So we have a teeter-totter, and the way a teeter-totter works is if one goes down, well, the other will go up, and so the average height would be maintained, right? On average it would be maintained. If this one went down, then this one would go up. And so what we do is this is a very important concept for the risk management section, is if the value of your dollar goes down, chances are the value of your gold will go up, and vice versa. And so we let our financial statement be our guide, and I recommended that you look at those 8 numbers either monthly or quarterly, or even weekly, and you set goals, and you say, gee, I would like to have more cash flow, or I'd like to increase my net worth, or I would like to maintain net worth and protect certain things. And so this to me is very basic financial education. It's the ability to do your own fundamental analysis, look at where you are, and decide what you want to buy. So let's go through these. So notice that this one has to do with calendar. If you have a business, you have a monthly sales report, or weekly or quarterly sales report. If you have rent, market's closed. If you have rent, then that means that It might be monthly or a 6-month lease, right? If you sell insurance in your business or have a dividend, these things produce income without selling the asset. Let me say that again. I can get income from my business without selling my business. I can get income from my stocks without selling my stocks. I can get income from my real estate without selling my real estate. Certainly the value of the real estate will fluctuate, but I can get income from stocks, real estate, and business, and even some commodities. If I turn it into a business like an oil well, that produces new oil, I can get income from the oil without selling the well. So this is our favorite kind of asset. Asset is something that I buy that puts money in my pocket, that generates new cash. We call these cash flowing assets. We talked a lot about this in the fundamental analysis section on your personal financial statement. It's now time to very much revisit that and say, what kind of assets do I want to have and how do I want to try to create my wealth? These are a favorite, no question. And they're based on the calendar, right? Dividends are paid quarterly, rent is paid monthly, sales are paid, in the business daily, come in daily, all kinds of cool stuff. Capital gain strategies is when I'm trying to buy low and sell high. Where I'm trying to buy low and then sell high to get back to a cash position. So I start with a small amount of cash and then wind up with a large amount of cash. This is less of a favorite for me consequently, because I really think that cash is losing value, in my opinion. So why would I want more of something that's losing value? Why would I go to a job and work my life away to get something that's losing value all the time? So I like the idea of having an asset. Doesn't mean I buy and hope and hold for the long term necessarily. There might be times where I do cash out, but when I do, I immediately look for another asset most of the time. And again, that depends on what's happening with cash and what the policies are. So this is where it creates new cash, right? New cash, and that cash is usually either spent or spun into more assets. Here's where I buy with a small amount of cash, and I want to sell high so I can have more cash, and then people can do that again. And I'm a little slower in the old days to nitpick people that do this, because the fact of the matter is there are some people who are pretty darn good at it. There are other people who are not good at it. I've seen people flip houses before and achieve their dreams. And so I'm going to be less dogmatic, and just because I think this is better, I'm not going to take away. If someone has a great system and it works for them and it's making them happy, then more power to them. It's not what I know how to teach, but more power to them. You do what works for you, and their financial statement will bear out whether they were successful or not, right? There are people who are stock traders who do very, very well, buying low and selling high, and we'll talk a little bit about that. Hedging strategies. This is protection. You'll notice that this is in a situation where if one goes up, the other goes down. If the other goes up, the other goes down. I mean, like so, right? Either way. And this is to maintain. This is not to get a tremendous gain in the net worth. As a matter of fact, your net worth will be protected in that it's like pouring an acid on something. We're trying to neutralize something. The word we use often is to what we call a delta hedge, because delta measures the move in price, right? Delta says, hey, if it goes up, what do I make? If it goes down, what do I make? And if we neutralize those with what we call a delta hedge, we're in a state of protection. We're in a state of saying, look, I'm not really looking to make money. I just don't want to lose money. I'm going to protect. And that's a very important skill to have, is there's times where we just hedge, and we probably always have a little bit of a hedge. What's ideal is if both of those could grow together, but they usually don't. It's usually opposing, and that's how the hedge works. Let's look at an example with stock. We used real estate here with rent and flipping houses here. With stock, of course, we have the dividend, and later on we'll talk about selling an option on that stock for even more income. So we have a dividend. We could also have what's called a premium, and we'll get into that. So we have a couple of different ways to get new cash from those investments. Of course, this is buy low and sell high again. right? Notice the dividend usually is paid out quarterly. Notice the calendar nature, that this is a timely thing. So this would be new cash or a new asset if it's a stock dividend. And this again is the idea to buy low and sell high, long or short, right? We could do that. And then the hedging strategy is again to protect and to insure, to protect this house. And we can do that maybe with an option contract to say, look, if we buy the stock and we want to be able, this might give us a promise or an option, maybe a choice. Option is choice, a choice to sell at a specific price, maybe $100. And so now, no matter what happened with this investment, up or down, we'd be able to guaranteed sell at that point, and we'd be protected. We talk a little bit about, we'll talk more about that, with some examples from Mark Cuban when we get in the risk management section. So the basic idea here is to say, I'm going to let my financial statement guide me depending on what my goals are, right? I'm going to look at that every month with my spouse or by myself, whatever the case may be. And I'm going to say, do I want investments for cash flow right now? Do I want income? Do I want growth? Do I want to speculate? There's one more thing I'd like to say about this before we get into paper assets, and we'll talk about the difference between what people call investing and trading. I stay out of that debate for the most part, simply because my feeling is if I have money in something, I'm invested. It's just period. Some people say, no, if you're doing it short term, you're trading. If you're doing it long term, you're investing. And to me, if I have money in it, I have money in it. And I think it's kind of silly to argue whether you hold a little while or a long while, you still have money out there. And whether you hold a little while, a long while, you still made a trade for, cash for this asset. In this, I leave the real estate up to friends like Kenny McElroy, Than Merrill. Those guys are the two of my best friends that just have done exceedingly well. Hundreds of millions, actually billions in transactions. They just really understand the real estate world. I'm more confident in speaking about the stock world and the paper world. So before we jump into short-term, long-term, capital gain, cash flow, stuff like that, let's speak a little bit about the 4 kinds of assets and what this course, as a beginning course, will focus on. 4 types of assets. We spoke about the currency market. This is the largest market in the world. It's trillions a day, $4 to $5 trillion moving, U.S. dollars moving around. We have home currency, we have foreign currency, and digital currency now is becoming more popular. Some people say that gold is God's money, and currency is the government's money, and digital is the people's money. I don't know if that's true, but that's an interesting way to look at it anyway. The debt market is a huge market. It's not as big as the currency market, but it's huge, and this is loans. And as of this particular class, this could change by the time you watch it, but as this particular class, this has been a market that is very, very large, but it's been tough to find yield. And for people to find great yield, and so people some have left this market, pulled money out to put it in equities. But here we have corporate stuff. This is important because a company like Apple might not want to pay U.S. taxes, so they keep their money in Ireland. And maybe if they pull that money over to the U.S., maybe they got a 35% tax rate they got to pay. Well, if you pull $1 billion over, and you're going to pay $350 million in taxes, why do that? If the corporate tax rate's 35%, well, why not do a 4% or a 3% bond? And just borrow the money to do whatever you're going to do and pay it back cheap, because this is not taxed and this is taxed. So corporate bonds are a great way for corporations either to raise money for expansion or do different things, or just to avoid a tax by borrowing money instead of spending money. Municipals are tax-free. That's when your city says, let's build a school or a park, right? Let's put in fiber optic in our infrastructure, and let's do a bond to raise money for that. Traditionally, these are tax-free. And then you have treasury bonds, and the U.S. Treasury bond in theory is risk-free. I think that is in theory risk-free. You know, Alan Greenspan says we can always spend money to pay our bills and to pay back money we borrow, but that's kind of an unsettling idea for some to think, okay, they can, I can send them money and then they can print it to give it back to me where it might not be worth as much. So these are IOUs, all of them, and that's the debt market. So you position yourself, you know, depending on what your goals are and what your feeling of safety is. What is the risk of this? Devaluation of the currency. What is the risk of this? Default if you hold it full term, and change in interest rates if you trade it and hold it short term. Equities. Equities where you own things. You get a piece of the pie that you get to take home. It's not an IOU. And, you know, most of us trade common stock, and the difference between common stock and preferred stock is if the company went bankrupt, you'd pay your loans first, then if there were any assets, you'd sell them off and give it to the preferred people, and then the common people would come up short. So this is the most risky of the three places to be. And, you know, there's different dividend paid here and here, and sometimes you can, like Warren Buffett, once the dividend got high enough for his U.S. bank, he switched it to common, and he had some warrants that allowed him to do that. And so these can be private or public. We're going to deal with public, but for example, every corporation that incorporates has shares. My shares in one of my corporations is owned half by me and half by a business partner. Another one I have is all by me. Another one I have is between half me and half my wife. And these are not for sale for the public. They're private. They're not for sale. And then we have finally the derivative market, which is a growing market, and this is mostly has to do with contracts and agreements where people are paying each other to make certain promises and do certain things. There's many types of bonds. You know, there's debentures and coupon bonds and non-coupon bonds and junk bonds, and well, there's many types of derivatives. There's credit default swaps, and there's options, and there's warrants, and these can be agreements that are public, that are traded on exchange, like options are, or they can be private, like a warrant between an individual and a company that's just between that person and the company. And the two we're going to play around the most with here, since this is a beginning class, is, you know, we'll build classes for this and this if people want them. But we're going to start here with common stock and options. That's the only two we're going to fool about with in an introductory class. There's enough there to get a good start of financial education, to get a good beginning, and learn some wonderful principles. Now, that's not to say you couldn't start a business and you couldn't invest in real estate or even gold. And there's even things, paper assets, that are not on this. I guess you could say that insurance is a sort of derivative, but I think I'd give insurance its own category. So there's all kinds of different things. But in here, we're going to begin with long positions on common stocks and options.